You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello and welcome to The Investor Way with myself, John McEwen, and my co-host Sam Ball. This week on The Investor Way, we have Tesco, Moonpig, Imperial Brands, Volution, Inditex, and Levi's. Sam, we'll start with Tesco's.
Do whatever you want, John.
I don't know whether it sounds ridiculous when listening to it, but I always say, should we start with Tesco's? You're like, yeah, let's start with Tesco's. So Tesco's had their half-year results out this week, with sales up 3% to 27.3 billion, ignoring the effects of exchange rates, and underlying operating profits jumping 41% to 1.5 billion pounds. Full-year underlying operating profit guidance has been upgraded and now expected to be between 2.5 and 2.6 billion pounds. Like-for-like sales in the UK and the Republic of Ireland were up 2.4% to 25 billion pounds, boosted by staycationing and the Euros football competition. But also the wholesaler Booker, which is part of the Tesco's business, saw a recovery in its catering revenue. Underlying operating profits rose 16.5%, and online like-for-like sales were up 74.1% compared with pre-pandemic levels and 2.3% ahead of last year. Over 700,000 customers have been added since the pandemic, with online sales now making up 14.6% of total UK sales. Like-for-like sales in Central Europe rose 1.4% to 1.9 billion pounds, with all markets returning to growth in the second quarter and underlying profit improving 18.6% to 68 million pounds. In the Tesco Bank, underlying operating profits more than doubled to 72 million pounds. However, revenue fell 12.2% as customers paid down their credit card balances. Tesco's incurred costs of 193 million pounds with settlements relating to the 2014 accounting scandal, and retail free cash flow rose from 0.8 billion pounds to 1.5 billion pounds, with net debt, including lease obligations, falling from 12 billion pounds to 10.2 billion. Alongside this, a 500 million pound share buyback was announced, and the valuation of Tesco's currently, it's trading at 22 times earnings with a market cap of 20.8 billion pounds. And in terms of its historical or its 10-year average price to earnings ratio, that's 11.5, and it's currently yielding about 4%. I thought these results were very impressive, being ahead of the lockdown trading by 3% and 8% ahead of 2019. And despite the headwinds facing the industry, as a market leader with Booker, the wholesaler, it puts it in the strongest possible position to weather these headwinds. Sam, what do you think of Tesco's and these results?
Same as you. I'm very surprised that they beat last year, given that they had all the panic buying. I like the business. The only thing I don't like is the bank, which I've talked about before. I don't think it's what they're good at. I just rather they didn't have the bank.
And on that point, they did sell the mortgage book off to Lloyds last year.
Yeah, I'd rather they just get out of it completely. I appreciate it's making a profit, but I don't know, just feels like a bit of a distraction to me. I'd rather they just sold it. Don't feel the same about Central Europe, just because it is profitable, and if it is still like grocery and retail, then I think that's fine. I know it's not contributing massively, so I'd probably be indifferent as to whether they kept that or sold it. I think at a PE of 22, it's quite pricey though. But then, like you say, if that dividend's quite close to 4%, I'd be uncomfortable paying a PE of 22 for it. As good as it is.
You would be uncomfortable.
Yeah, especially on the back of those results. Like, it's not going to be putting up figures like this year after year, I don't think.
No, fair enough. And if you compared it with the Morrisons takeover, what premium did they pay to? It was about 60% of what Morrisons had been trading at.
Yeah,
it was trading at maybe 11 times earnings.
It was something like that. So yeah, it probably did take it up to about 20. I just struggle with it. I guess you'd argue with interest rates being as low as they are, where are you going to find a better business that's really cheap? But my answer probably would have been to that 6 months ago. Well, Morrisons probably isn't as good as Tesco, but when it's at half the PE, I prefer Morrisons, but that's not an option anymore, is it?
Do you think Tesco's would be a takeover target for anyone.
I don't know, you'd have to pay up for it, wouldn't you? I mean, how much of a premium are you going to pay on that? Because you do need to make some money off it at some point as well.
Yeah, that's true.
I think it's difficult when it's already so expensive.
No, fair enough. I've owned Tesco since before the accounting scandal of 2014, and I calculated actually before the show, I'm still 20% down on it, even with all of those dividends that have been paid out.
So, I was going to say, what about the dividends? If it carries on paying 4% a year and stays flat, in 5 years, you've got your money back.
Yeah, so maybe a decade after I bought it, I might have, broken even maybe, if I'm lucky.
If you don't count inflation.
Yeah, if you don't count a lot of things really, trading fees, everything. But anyway, moving on from that, our next company is Moonpig.
Yes, Moonpig. So Moonpig, the company who do the cards that you get online, they have come out with a trading statement. However, this is the first time we've looked at Moonpig on the show. They only listed within the last year or so, and they have had full year results previously, which I think it was in that period where all the big companies were reporting, so we just never got around to covering it. So I think it'd be useful to just go through the full year results before the trading statement. So these results for the period ended 30 April 2021, and they are a few months old at this point. Orders increased by 109%, and that was driven by uplift in new customer acquisition and elevated purchase frequency during lockdown. So as well as just the cards, if you've ever used it, you might have seen that you've got the chance to send a gift as well. So they're given the revenue mix for the gifts, and the gifts make up 46.1% of revenue, and that's up from 40.8% 2 years ago. And that's split between standalone gifting of 5.9% and attached gifting, where it's with a card, of 40.2%. The overall revenue increased by 113% year over year. The group gross profit increased by 103% to £186 million. Group gross margin decreased to 51%, and that was driven by the growth in attached gifting mix, Moonpig promotional activity to drive app downloads and reminder setting, and increased outsourced card fabrication. They had total capital expenditure of 10.8 million, which is obviously very low. And they had net debt to last 12 months adjusted EBITDA of 1.25x, which is comfortably below the guidance they gave at the IPO. So they've actually, as well as Moonpig, they've got another business called Greets.nl, and that's basically the Moonpig of the Netherlands. So in the UK, Moonpig has a 60% market share, and in the Netherlands, Greets has a 65% market share. Those are obviously very, very good results, and they have since come out with a trading statement. And in the trading statement, they've basically said, trading in the year to date has been strong. Frequency remains elevated following a limited change in consumer mobility through the summer, despite the lifting of lockdown restrictions. In light of this, we are raising our guidance for group revenue in the 2022 financial year, which we now expect to be between approximately 270 and 285 million. We have invested at a higher rate in the long-term growth drivers of our business, including promotional activity to drive strategic levers such as app downloads and customer reminder setting, and through the development of our technology platform. As people return to offices and conditions normalise, the data we collect on customer behaviour will provide important insights. At the current time, our view on underlying growth trends and our medium-term growth and margin targets remain unchanged. So, if you take this revenue that they're expecting for the 2022 financial year compared to pre-pandemic levels, it does show a pretty impressive growth rate. However, if you use the midpoint of the guidance of 280 million and compare that to last year's revenue, which was 368 million, that's still a 24% drop year over year. I appreciate they had a really good year because of the pandemic. Everyone was trapped at home. All their competitors were shut. However, this is so their market cap's 1.05 billion, and they're trading at about 51 times the 2021 earnings. And I just think 51 times, I mean, the share price has not had a great time since it listed. So it's currently at 306p a share, and that compares to a 52-week high of 498p, and it's not too far off the low of 280p. But that low was only set within the last couple of weeks. So, but I just think, I don't know how much interested I'd be in the business anyway, because although it's like online and they say it's not like capital intensive, you still have to make and send out the cards. It's not like a pure internet play. But I just think for a company where revenue is going to be down 24% for the year, to pay a P of 51, for me is very expensive.
So and what's in terms of debt? How much debt does it have?
I didn't actually look at the actual amount of debt. I just saw that it was 1.25x the whatever they called it. Was it the adjusted EBITDA or something else? Some of the silly metric.
Fine.
But for a business like that, with such low capital expenditure, I don't think that just doesn't look like it's at an unsustainable level. It doesn't look like it's at a concerning level. So what are your thoughts on Moonpig and this trading statement?
I certainly wouldn't be paying 51 times earnings, and it's quite niche. It's something that I don't know anything about. I don't know what its main competitor is, and I don't really know the market.
Maybe Funky Pigeon, I imagine. Those are the only two.
Funky. Okay. We see. I'm not well versed at all on it, but no, I probably wouldn't be looking much further at the current valuation, just regardless. But I don't really have that much more to add, to be honest.
Not going on the watch list then.
No, not even close.
Right, should we move on to a company that might be going on the watch list then?
It's certainly a company that's much cheaper than Moonpig. So Imperial Brands, which is the second largest company listed on the FTSE 100, they've had a trading update out this week with underlying revenue expected to grow at just 1%, and that's largely down to strong tobacco pricing and reduced losses in the next generation products, so their e-cigarettes, heat not burn devices, which means that they're now expecting profit growth in the low to mid single digits, which is in line with market expectations. In the combustibles division, so for the most part regular cigarette, there'd been an increase in investment across Imperial's main markets, and it's limited its market share losses to 0.03% decline, and that compares with a 0.17% decline last year. And there were increased legal costs, particularly in the US, and reduced revenue in Australia, so overall reduced underlying operating profits. However, an overall tobacco volume increase should be in line with expectations, with cigarette market share increasing by around 0.2%. In the next generation products, revenue in the second half is expected to be in line with revenues from the first half, and the group is exiting markets with lower growth prospects. And Imperial have also launched heat not burn trials in the Czech Republic and in Greece, and they're continuing to test new marketing strategies for their e-cigarette brand Blue in the US. The chief executive, Stefan Bomhard, said, "We have made good progress in implementing our strategy through a sharper management focus, greater investment behind our priority combustible tobacco markets, and new market trials in heated tobacco and vapor." In terms of valuation, Imperial's incredibly cheap. It's got a market cap of £14.5 billion and trades at just 6.3 times earnings, with a prospective dividend yield of 9.3%. And that compares to the 10-year average PE 10.6 times. In my view, Imperial appears incredibly cheap, which I think is probably down to a few factors. One of them is the trend for ESG investing and institutional investors dumping and unloading their shares of Imperial, and the fact that it's also, being in the tobacco sector, it's an industry in structural decline with fewer people smoking. But the balance sheet for Imperial, it's healthier now than it was a couple of years ago, having cut the dividend by a third, and it's been able to pay off some of the debt associated with the $7.1 billion purchase of Blue, the e-cigarette brand, back in 2014. And while they may have overpaid for Blue, when we looked at British American Tobacco not that long ago, we saw that the revenue is growing rapidly, and it's maybe not yet profitable, but it is growing rapidly in the e-cigarette market. And then I suppose alongside that, in parallel, you do have the combustibles. And even if that is in decline, the price is relatively elastic and they're able to pay out this huge dividend, which is nearly 10%, despite it having been cut about a year ago. The other thing that might be said about it at the current valuation, is it a takeover target? I don't know what you think about that, Sam.
I don't know. I probably wouldn't buy it in the hope it would get taken over, but I wouldn't be against buying it because it's so cheap. I did used to own it, but I sold it probably around the current price just because, well, I just had something else that I wanted to own more. But it's incredibly cheap. Revenues aren't declining, profits aren't declining, and the dividend yield is insane considering how secure it is. I mean, we say it every time, and I know it's going to be a bit of a boring show this week because it's just the two of us agreeing with each other. But I struggle to see how much lower can it go? That's sort of what I think. Because if profits aren't going to decline, a PE of 6 is insane.
Do you think market sentiment would be likely to change with it, or do you think it may be just that these tobacco companies, Imperial Brands and British American Tobacco, continue to trade around the current share price, but they just continue to pump out, well, the steady earnings and huge dividends?
I mean, just with the way the world is and the way it's going, I'd be surprised if we get some kind of, I'd be surprised if we saw some kind of revaluation that takes up to a P of 15 or 20. Yeah. And if it happened and you start holding shares, then that's obviously fantastic. But I think if you're buying it with the expectation that the PE ratio is going to stay the same, but you're going to take your 9.3% dividends a year, which is probably going to be a market-beating yield. Yeah. And then you just go and reinvest that somewhere else, and you almost use it just to generate the cash.
And in the world elsewhere of close to 0% interest rates, you could see why people might do that, ethical concerns aside.
Yeah.
And I mean, for reference, it's interesting. If you look at Altria, or if you look at Philip Morris, Altria has a market cap of nearly $90 billion and trades at about 19.5 times earnings. And Philip Morris has a market cap of about $150 billion and trades at about just under 17 times earnings.
They are in the US.
I appreciate that they are in the US, and many people would argue that they've got stronger brand. Well, Marlboro in their portfolio, which is probably the best known cigarette brand.
So yeah, I wouldn't pay 19 times earnings or 17 times earnings for a tobacco company.
Would you pay 6 times?
Well, I did.
You did.
Yeah. I mean, I would. I'm not gonna. I don't have any plans to buy more or rebuy it just because I think I can do better. Because although that 9.3% is very impressive, time may prove me wrong, but I hope I can beat it.
Yeah. No, fair enough. So even if it just churn that out,
but it's not a bad result, is it? If it does that.
No. So no, interesting, because I think after Brexit, when we were back in 2016, these companies were trading at sort of 15 to 17 times earnings, which, it may have been a bit expensive, but certainly given the figures. So I think there's a lot to be said for that institutional investors offloading the shares, really. And that's probably depressed the price.
Should we move on to Volution?
Volution, yeah.
Sounds like a nightclub, I think.
Yes.
So we're moving from a company that I guess sort of pollutes the air, doesn't it, with smoke, to one that tries to clean it up. So Volution, for anyone who haven't heard of them, which included me prior to today, Volution Group is a supplier of ventilation products to the residential and commercial construction markets in the UK and Northern Europe. The company is principally engaged in designing, manufacturing and distribution of unitary and systems ventilation products and equipment. It's also engaged in the designing, manufacturing and distribution of a range of motors and components for use in air movement applications and gas boilers. It operates in 2 segments, Ventilation Group and Original Equipment Manufacturer. The Ventilation Group segment consists of 15 brands focused primarily on the UK, the Nordics, Central Europe and Australasian ventilation markets. The Torrin Siphon segment, which is the Original Equipment Manufacturer, is a supplier of motors, motorized impellers, fans and blowers for the European heating, ventilation and air conditioning industry. The company offers Revive, which is a bathroom and kitchen fan. So they have come out with their full year results, and they've announced significant revenue growth, up 56 million to 272.6 million. That compares to 216 million in 2020 and 235 million in 2019. So that includes organic growth of 22% and inorganic growth from the 3 acquisitions in the year of 3.8%. They achieved their 20% adjusted operating margin target 6 months earlier than planned, with adjusted operating margin of 20.9%. That compares to 15.6% in 2020 and 17.8% in 2019, despite ongoing supply chain challenges and inflationary pressures faced by the group. Have you noticed how there's at least 1 or 2 companies every single week now that's talking about inflationary pressures?
Well, they are real.
They are real, but the government try and tell you there's no inflation.
Oh, I see. Sorry. I thought you thought it was excuses. And I was like,
no. I accept they're real. I just think the government should too. So they've reported profit before tax of 30 million. That compares to 14.6 million last year. The business remains highly cash generative, with operating cash flow up 30.6% to 56.9 million and strong cash conversion of 97% as a result of the asset-light business model. 42.2 million was invested in 3 acquisitions in the Netherlands, Sweden and Finland, further enhancing their product range and low carbon credentials. Net debt, excluding lease liabilities, is stable at 53.8 million, with leverage, which is measured as net debt excluding lease liabilities divided by adjusted EBITDA, ending the year at 0.9x, and that's down from 1.3x last year. They had adjusted earnings per share of 21p, which has a compound annual growth rate of 13.2% since the IPO in 2014, so not too shabby at all. And dividends resumed during the year with a total dividend of 6.3p per share, reflecting strong profitability, free cash flow generation, and confidence in the business model. So there are a few interesting points on the slides. So the first one, they've got a sustainability slide where they talk about their ambitions, and 2 of the ambitions is listed are for the product and planet. So for the product one, they said their ambition is to champion the energy saving potential of their products and solutions and support the net zero ambitions of the countries in which they operate, and to continue to develop clean air solutions that protect people's health and increase the comfort in an ethical and responsible way. So for the planet ambition, that is to reduce their environmental impact by improving business efficiencies and minimizing their impact on the climate, to focus on the quality of materials they use to support the creation of a circular economy and eliminate all forms of waste across the value chain. So it's what you'd probably describe as woke, for anyone who's interested in that. For the adjusted operating margins, they've split them. So they were 20.9% for the group. And in the UK side of the business, it was 20.6%, 26.6% in continental Europe, and 21.7% in Australasia. In terms of the revenue from each segment, 49.9%, which is 135 million of the revenue, comes from the UK, 35% from continental Europe, which is 95.5 million, and 15.1%, which is 41.2 million, comes from Australasia. So it's quite nicely diversified as well. These results do look quite impressive. If you then go on to the financials for the last 5 years, they're also quite impressive. It's just growing at a nice steady rate. So 2017 to 2021 years inclusive, revenues increased from 185 million to 272 million. Operating profits increased in that time period from 20.42 million to 34.21 million. And diluted earnings per share has increased from 7p to 10.4p. In terms of the valuation, the business has a market cap of 936 million and trades at a PE ratio of 21.93%. And it also has a dividend yield of, it's saying 1.33%. I'll just check that to see whether.
What did you say the price to earnings?
Yeah, 1.33% looks about right. Price to earning, it's 21.93.
21.93.
I thought it looked like, well, my view is these are obviously, I thought they were good results.
Yeah.
Looks like quite a good business. It's growing away quite nicely. PE of 21.93 is not cheap, but for a business that's compounding at what was it, about 13% a year?
Yeah,
I don't think it's unreasonable.
What do you think? Do you think the business or the sector has any headwinds? And have you looked at it any more broadly or seen any of the other companies operating in the same space?
I don't know very much about the sector at all. In terms of headwinds, I suspect it's got a lot more tailwinds than headwinds just because of the way the world is heading. Probably the opposite of the position that Imperial Brands is in, I guess.
Yeah, which is reflected in the valuation, to be fair.
Yeah, it is, yeah. But no, I don't know much about the industry. I don't know much about the products. I think it looks like a good business, but I think there are probably better businesses out there for me.
Okay, yeah.
But no, I do like the look of it. What do you think?
Okay. Yeah, no, it's from what you've described and from the results, it does look like a well-run business. It's just one that I don't know very much about, and I'd probably have to read up more on the sector generally to understand it a bit better. But no, good results.
Yeah, it's certainly got a shout at being my stock of the week. It's not completely ruled out.
No, okay. Well, there's a lot to be said for it then. Okay, so Inditex is our next company. It's actually a Spanish-based company, best known for its brand or its shop, Zara, but it does have a number of other sub-brands, Bershka and Stradivarius, amongst others. Anyway, they have their half-year results out with second quarter sales reaching record levels and total first half sales up 53% to 11.9 billion euros, with a net income of 1.3 billion euros, up from 195 million euro loss at the same time last year. And the group advised that the autumn and winter collections were being well received, with bricks and mortar returning to normal levels, but online sales importantly continuing to grow. And online sales up 36% ahead of last year and 137% ahead of 2019. And they're expected to make up over a quarter of total sales for the full year. In terms of physical retail, the group has 6,654 stores and 99% of them are now open. Zara is by far the biggest brand at 71%, or accounting for 71% of net sales, and Zara's revenue rose from 5.5 billion euros to 8.5 billion euros. Operating margins were 14.1% compared with negative 2.5% last year, and operating expenses were up from 3 billion euros to 3.8 billion euros. So continuing the same theme as you mentioned, Sam. By the end of July, the group had a net cash position of 8 billion euros compared with 6.5 billion last year. And the group said investments in the period 2020 to 2022 will be around 900 million euros per year. The investment plan includes a digital investment of 1 billion euros over 3 years. In terms of its valuation, Inditex has a market cap of 95 billion euros and trades at about 25 times earnings with a yield of just over 3%. I mean, they were very impressive results, I thought, although if you look at sales overall, they're still 5.5% behind 2019. But I think Zara is a particularly strong brand and possibly the most on-trend and desirable in terms of high street fashion. And it's managing to transition to online remarkably well. Very similar to Next, actually, on that front. Downsides, I suppose it's not cheap, and potentially it would be more at risk if there were to be an economic downturn, because it's a bit more higher end in terms of the high street retail. But I don't think there's many negatives when it comes to Inditex, actually. Thoughts, Sam?
I think it's quite expensive. That's my first thought. For a retailer, it's 25 times earnings. I think that's a lot. I don't think it's as good as Next, just because the online sales only make up a quarter of the total, whereas Next, it was the majority were coming from online. Yeah.
It's growing at a very rapid rate, though, the online retail.
Yeah, but so is everything in the last couple of years. Yeah, I just think at a P of 25 for a retailer, I think it's too much for me. I'd be uncomfortable paying that.
Yeah, I mean, the margins, the much better margins you'd expect with Tesco's, for example.
Yeah, but I wasn't comfortable paying 22 times for Tesco's either.
Okay, fine. I mean, yeah, if you ask me, I probably wouldn't be either, but I think they are.
Watch this.
No, I think I think they're good results, but no, I would probably choose Next over Inditex. But what I'm sort of watching
was
more,
only like a P of like 15 as well, wasn't it?
Yeah, it was. And I suppose what I'd be watching probably even more closely, or I'd be more interested in the Next, would be probably ASOS actually. I think I'd be more attracted to that and the growth potential with it. And now that it's a more reasonable valuation, the same with Boohoo actually, both that pair.
I'd have any of Boohoo, ASOS or Next before Inditex.
Yeah.
But good results. Although I would
Good
put the
results.
caveat in that they were against easy comparators as well.
Yeah. And I suppose the other thing is that, a lot of Europe has been slower to come out of lockdown. So that distorts it a little bit too, I think.
I mean, that was actually a European company. Should we move on to our US company?
Yeah. So, another more famous clothing brand, Levi's.
Yes, Levi's, who do the jeans, in case you haven't heard of them. I imagine most people have, though. So they have come out with their Q3 results, and they've announced reported net revenues of 1.5 billion, which is up 41% compared to Q3 2020 and 3% compared to Q3 2019. The direct-to-consumer segment reported net revenues up 34% versus Q3 2020 and 4% versus Q3 2019. Global wholesale reported net revenues up 45% versus Q3 2020 and 3% versus 2019. Net revenues through all digital channels grew 10% versus 2020 and 76% versus 2019. Digital sales represented approximately 20% of total third quarter revenues. Gross margin was 57.6%. Adjusted gross margin was 57.5%. I do wonder what the point of adjusting it is for 0.1%, but there you go. Operating margin was 14.4%. Adjusted EBIT margin expanded to a third quarter record of 14.8%, up from 7.9% in 2020 and 12.2% in 2019. Net income was $193 million. Adjusted net income was $197 million, up from $31 million in 2020 and $128 million in 2019. Diluted EPS was 47 cents. Adjusted diluted EPS was 48 cents. Again, what is the point of these adjustments? Adjusted free cash flow for the first 9 months was $251 million, which was above the prior year. And subsequent to the quarter end, the company completed the acquisition of Beyond Yoga for an aggregate purchase price of approximately $400 million, diversifying the business into a high-growth activewear segment. And the board authorized a $200 million share purchase reprogram. In terms of the revenues per segment, so American segment revenue was $838 million, that was up 52%. Europe revenue was $494 million, and that was up 27%. And Asia revenue was $165 million, and that was up 34%. So the Asian revenue is actually still quite low. If you go on operating income for the period, the American operating income was up 120% from last year, Europe 59%, and Asia was only up 30%, but that's still a loss. It's actually an operating loss still. In terms of the financials for the last 5 years, so 2017 to trailing 12 months, although it's had these impressive results, it's because 2020 was not a very good year. From 2017 to the last 12 months, revenues only increased from 4.9 billion to 5.4 billion. Gross profits only increased from 2.5 billion to 3.1 billion, and operating income has increased from 467 million to 615 million. So it's growing at, I suppose it's above inflation, but it's not huge growth. It's trading at a market cap of 9.82 billion and a PE ratio of 22. However, once the Q4 and full year results out, if they hit what they're saying they're going to hit, it's probably more a forward PE of about 17 based on the outlook for the final quarter. Yeah, so I mean, it's a very good brand. A PE of 17, it's not outrageous. It's got a dividend yield of about 1%. I'm just not sure where the growth's going to come from. I guess you could say Asia, but they're not really delivering on it so far.
What did you say it's trading at? Sorry,
showing as 22, but that's based on last year's results. If you assume Q4 is going to be what they say it's going to be, which I think this late into the year it probably will, it's a forward P of about 17. So yeah, I think it's all right.
It's all right. It's not outrageous, but like you say, the growth prospects perhaps aren't.
If they could crack at Asia, but I don't know how much weight the brand carries over there, because it is jeans, isn't it?
Yeah, that's right. No, I don't know, but no, I like the brand, but
I think it's
don't know whether it's just a fair valuation of that company.
Yeah, I think it's one of the more reasonable valuations that we've looked at recently for a US company, because that is a good brand at 17. If you compare that to like McCormick last week at like, what was it, like 30?
Yeah,
I definitely prefer to pay 17 for Levi's.
Yeah. What's Nike trading at?
Oh God.
Or Nike?
Let's have a look. It's going to be expanded. I reckon like 60 plus. 40. That's a lot.
Yeah.
For a company that big as well that sells shoes.
Yeah. It's
I probably prefer Levi's at 17.
Good. Fair enough. Okay. So of the companies this week then, what would your preferred, if you were to pick one?
It's between Imperial Brands and Volution, actually. I'd probably go with Imperial Brands. I'd rather just take the 9.5% dividend yield.
Yeah.
What about you? Ethics aside.
It's quite difficult actually. I don't love any of the companies really.
I like Tesco as a business.
I like Tesco's. Maybe I would go for Tesco's, but
you'd pay the 22.
I don't know whether I would.
You'd be unhappy paying it.
Yeah, I would be unhappy. I would be unhappy paying it, but I might. Yeah, maybe I would go for it. I don't know. Difficult this week, I think.
I'll second then.
Probably Levi's.
Okay. It's unusual for you to pick the US company.
Well, yeah, but it's unusual to have a US company that trades under 20 times earnings, isn't it?
Yes, that's true.
And I like the brand. Okay.
Okay, then. I think that's everything then.
I think it is.
Right, well, thank you very much for listening, and we'll see you all next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.